Hey everybody, welcome to Low Appraisals for Dummies. I got to give a quick shout out to my boy Trey for the content here today. We're getting lots of questions from both realtors and buyers alike about the appraisals, what happens if it comes in low. And the real issue is, in today's market, in order to win that contract, you're likely to have to remove the appraisal contingency. You're probably bidding over the asking price. So the question I get is, what happens if my appraisal comes in low? Do I have to bring the difference to settlement in cash? And the answer is maybe. Or maybe not. The solution to this may be simpler than you think. So first off, before we even write the contract, we're going to try and get an appraisal waiver. If we can get an appraisal waiver, there is no appraisal, therefore it can't come in low. Now, can it? Now, you're not going to get an appraisal waiver all that often. There has to be certain criteria met. One, it's going to have to be a conventional loan. The sales price is going to have to be less than $1 million, 20% down or more. And what we'll do is we'll get the property address, I'll plug it into the system, and we'll run it through at your offer price. If there's an escalator, we'll run it to the top of the escalator and see if and where that appraisal waiver comes in. That's going to be great to know beforehand. But the real problem here is if you're not putting down more than the minimum. So for example, FHA requires 3.5% down, VA, no money down, conventional 5% down. There's some first-time home buyers at 3% down. If you're putting down the bare minimum, then we have no leeway, and yes, you are then likely you're going to have to bring that cash to closing. Now, where this solution really comes to play is if the borrower is putting more than the minimum down payment, then we have some leeway to play with. Conventional financing just requires 5% down on loans all the way up to $1.15 million. So as long as the appraisal is leaving at least 5% equity in the property, we can solve this problem, and we can do it very quickly and easily and efficiently. So let's run a quick example. In this example, we're going to use an $800,000 sales price, and we're going to do this at 10% down. Minimum down payments, 5%. We're putting 10, so we've got a little leeway here. This is a 90% loan to value. Now, in this scenario, because they're not putting a full 20% down, they are going to pay PMI. PMI is private mortgage insurance. And in this scenario, with good credit, that PMI on a monthly basis is $78. Now, let's say that this appraisal does not come in. Let's say it comes in $25,000 low. Well, that's going to give us a value of $775. Now, if I take my 720 and divide it into 775, that gives me a 92.9% loan to value. Now, your sales price is still $800,000. Your loan amount is still $720,000. You're still bringing the same amount to closing. Your interest rate stays exactly the same. All of your other features stay exactly the same except PMI. Now that you're at 92.9% loan to value, that PMI goes all the way up to $114 per month. So at $114 per month, your delta, the difference in payment, is $36 per month. So if it comes in $25,000 low, you don't have to bring another $25K to the table. The world is not coming to an end. This is very solvable with $36 a month. Now the next question you're going to ask is, where is the bottom of this? How low can that appraisal come in? And based on this loan amount of $720,000, this property needs to appraise at least $758,000, which is exactly 95% loan to value. And as long as it comes in at this number, then I can solve it just like this. So it's not quite as scary as you think, is it? If you want to chat about this or anything else, give me a shout. The formula you need to solve your mortgage problems is 703-727-4478. Tom Reed signing off.